G'day guys, welcome back to the Devon Too Good investing channel. So we've got some big news here. Charlie Munger, who manages the Daily Journal Corporation's investment portfolio, has released their 13F for Q1 2022. And you can see here that he has reduced Alibaba by 50%. So now it makes up just over 15% of his portfolio. So in this video today, we're going to be going over why he might have sold 50% of his Alibaba position. And then I'm going to reiterate my investment thesis in Alibaba and why, honestly, I'm not too concerned about Charlie Munger and his 50% reduction in Alibaba stock. So there's many reasons why Charlie Munger might have sold half of his Alibaba position. And I've got 6 potential reasons here on why you might have sold. And the first reason is that Charlie Munger's investment thesis has changed, or in other words, he no longer has conviction in Alibaba. And I do find this reason quite unlikely, as he's only sold half of his position, and if he really lost conviction in Alibaba, it makes a lot more sense for him to just completely exit his position. This also makes very little sense because over the last few quarters, he's doubled down on his position multiple times. So for him to sell now after just doubling down, that makes literally no sense, considering that over the last quarter, we've received no new bad news that would have changed his opinion. The second potential reason on why he might have sold is due to pressure from the board of directors. Potentially there's people on the board that do not like his exposure to China. So, I mean, I've got no way of proving this. This is just pure speculation, as is all of these reasons here. But I suppose that is something that we have to consider, and it is a possibility. And the third reason is that Munger might have found a better opportunity. And the interesting thing about it is he reduced his exposure by exactly half. So what if he decided he wanted to go half into Tencent or maybe Prosus and half into Alibaba to get that sort of mixed exposure? And we saw Mohnish Pabrai do the same thing, where he sold the majority of his Alibaba position and just moved into a better opportunity, which was Prosus. The next reason is tax loss harvesting. Of course, this is a possibility, but it is kind of weird to do it in the first quarter. Usually tax loss harvesting is done in the fourth quarter, but hey, I guess it's a possibility and we got to take it into account. There's also a possibility of a margin call. So Daily Journal Corporation does have margin debt, which they use to invest into Alibaba. However, when I looked on their balance sheet, it was about $37 million in margin debt, but their portfolio is like $400 million. So as a percentage of margin, this isn't an excessive amount, so a call is fairly unlikely. However, in rebuttal to that, if you look at the shares he sold, he sold 300,000 shares, and if you times that out by the recent stock price, if you let's say he sold it at $100, for example, so 300,000 times 100, that gets you at 30 million. So that is pretty close to the size of his margin debt. So maybe he just felt uncomfortable with the margin and sold it off. Although, like I said, I have no proof or anything like that yet. And possibly we might find out when Daily Journal file their next quarterly earnings. And then the final reason he could have sold is that he wanted to transfer his Barber shares listed on the US exchange and instead buy the HK9988 shares listed on the Hong Kong exchange to avoid the whole delisting risk. And I also find this reason to be quite unlikely due to the fact that Charlie Munger's mentioned many times that he feels comfortable with owning shares on the US exchange. So now that we've talked about the reasons why Charlie Munger might have sold 50% of his shares in Alibaba, let's talk about what I'm doing and why this literally doesn't change anything for me. So first of all, we got to look at the business and what we're paying for it versus what we're getting. So we want that relationship to be heavily in our favor. So if we look at the market cap as of today, Alibaba is trading at $276 billion. They've got $71 billion of cash and short-term investments on their balance sheet and $24 billion of debt. So that gives us a net cash position of $47 billion. So if we take that net cash and divide and minus that from the market cap, that gives us an enterprise value of $229 billion. And based off 2021's free cash flow of $26.8 billion, if we divide our enterprise value by last year's free cash flow, that gives us a ratio of 8.54. And this is on a business that I think will conservatively grow 10 to 15% per year over the next 5 years. And on top of that, 23% revenue growth is expected this year. Alibaba has a huge user base of over 1 billion people. It has a fairly dominant moat in e-commerce with its iron triangle between logistics, their payment solutions, and their huge networking effect, which exists on Taobao and Tmall. And then you've got that huge cloud potential where, if the cloud business goes right, it could be almost as large as the market cap now in 5 years. And Alibaba projects that the cloud market in China is gonna 5x between the year of 2020 and by the end of 2025. So if that does happen and Alibaba retain their 37% market share in the cloud market, look, it's going to be worth at least $100 billion, if not several $100 billion, depending on what kind of multiple the market decides to sign onto that cloud business there. And then on top of that, they also own a 1/3 stake in Ant Group, and Ant Group originally was going to IPO for roughly $300 billion. This obviously didn't happen. The CCP shut it down, and they decided they wanted to regulate, this kind of sector that Ant Group operate in. So let's just say, if it was to IPO now, it'd be worth $100 billion, which is 67% less than what it originally might have IPO'd for. And Alibaba, they own a 33% stake in Ant Group. So that might make the position worth around, $33 billion. So if we jump over to my discounted cash flow valuation of Alibaba, you can see that I've entered in growth rates between 10 to 14%. And I've entered in 2021's free cash flow. And I've also reduced this free cash flow in 2022 to represent some of the regulatory changes that have reduced their free cash flow. And then from that, I've taken the free cash flow back up to where it was in 2021. And then from there, grown it at the growth rate seen just over here, that 10 to 14% range. And as a result of that, and after assigning a 15 terminal multiple, you can see that we're getting buy prices between $100 and $106 for a 27% return. So pretty much, if these models play out and you agree with my inputs here, over the next 5 years, you should expect a 27% per year return based on these figures here. Now, obviously, there are risks with investing in China. And honestly, in my opinion, over the last few months, I feel like these risks have reduced a little bit. So one of the major risks was China invalidating the VIE structure. And recently the CCP came out and they were talking about how they were willing to support listing on overseas exchanges, and that they were looking and actually, starting to slow down some of this government regulation. And most of the harsh regulation that we've seen is actually behind us. That's what they said. Now, whether they stick to their word, we'll find out. However, if good words are better than bad words, right? So, but we'll see what happens with that. But obviously, there's the VIE risk. There's those donation risks to the common prosperity, and as long as they don't get out of control, this isn't a major risk. And then obviously the unforeseen regulations that might come about, which end up affecting free cash flow, which I have actually sort of factored into my valuation. Then we also have those minor risks. For me, delisting is a minor risk. I'm not too worried about it. I do have here about a 50% chance of happening. I think the chance of this happening is actually less after the CCP came out and said, hey, we're not going to try to delist Chinese companies off US exchanges. We're going to try to comply and try to work with the US. Obviously, competition is a risk, and this is pretty much a guarantee that Alibaba are going to face increased competition from the likes of JD.com and Pinduoduo, and then also from the likes of Tencent Cloud when it comes to the cloud side of their business. And then we've also got further donations, but they're not deal breaking. This is fairly likely that these sort of donations will continue on in the future. But however, if it's not a huge amount of the free cash flow and the valuation is so cheap, then it's probably not that big of a deal. And then obviously no Ant Group IPO. Yeah, obviously an Ant Group IPO would unlock a lot of value for shareholders. However, it's not the end of the world if this doesn't happen. So, and at the end of the day, Alibaba is still going to own 1/3 of Ant Group either way. So, guys, in conclusion, Charlie Munger, he sold off 50% of his position. There's many reasons why he could have done it, and we can't be sure for what reason he sold. However, I am confident in my original thesis in Alibaba, and I'm going to stand by my research. I'm going to stand by my valuation, and I feel like the risks aren't as bad as what they were a few months ago with China coming out and saying they're willing to support US listing of Chinese companies, which obviously then decreases the delisting risk and the VIE structure risk. So, guys, thanks for watching. Make sure you like, make sure you subscribe, and I'll catch you in the next video.